You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined by my co-host, John McEwen. It's the 27th of September, 2022. And in this week's episode, we'll be discussing the City of London Investment Trust, JD Sports Fashion, Haleon, Keyword Studios, PZ Cussons, and Costco. John, shall we start off with City of London Investment Trust making its debut?
Its debut, yes. So City of London Investment Trust, one of the biggest actively managed closed-end funds listed on the FTSE 250 with total assets of nearly £2 billion, had their full year results out last week. And as it's the first time that we're covering it on the show, it's probably worth giving a bit more of a background to the company and outlining their investment objectives before digging into the results. So the company actually started life in 1860 to acquire a family-owned brewing business called Calvert's in London, but it's been investing in securities since 1932. And quoting from their website, the City of London Investment Trust aims to provide long-term growth in income and capital, principally by investment in UK equities with a bias towards large multinational companies. The board fully recognises the importance of dividend income to shareholders. The trust provides UK investors with exposure to global growth through the portfolio's overseas revenues. It has a conservative management style that prioritises sustainable income and long-term capital growth. The trust measures itself against the FTSE All-Share Index. To give you a flavour, their top 10 holdings are as follows. Number 1, British American Tobacco at 4.61%, Shell at 3.95%, Diageo at 3.75%, BAE Systems at 3%, RELX at just under 3%, BP at 2.86%, Astra at 2.84%, HSBC 2.72%, Unilever 2.58%, and Imperial Brands at 2.58%. The highlights for the full year results were a net asset value total return of 7.5% in the financial year ended June the 30th, down from 20% in the financial year 2021, but beating their benchmark 1.6 return of the FTSE All-Share. Their net asset value per share is £3.90 on June the 30th, up 0.9% from £3.87 a year earlier. Revenue earnings per share were 20.7p on shares of around £4, which is up 21.2%. The fund trades at a 2.5% premium to its underlying net asset value. The share price is up 7.7% on the year compared with 1.6% on the benchmark. The dividend was increased by 2.6% and represented a 56th consecutive year of dividend increases and came in at 19.6p. Over the past decade, the dividend is up 41.2%. Gearing at the year end stood at 7.1%, which contributes 1.5 percentage points to the outperformance due to the decline in the fair value of their secured debt. Stock selection contributed 4.7 percentage points, helped by the portfolio's tilt towards large companies and dividend yield, away from highly valued growth stocks and medium-sized and small companies. The biggest stock contributor was BAE Systems, the defence equipment manufacturer, followed by Imperial Brands, the tobacco company, Brewin Dolphin, the private client wealth management group, which received a takeover bid from the Royal Bank of Canada, was the 6th biggest stock contributor. The underweight position in Shell was the biggest stock detractor, somewhat offset by the holding in Total Energies, the French international oil group, which was the 8th biggest stock contributor. The second biggest stock detractor was being underweight AstraZeneca, although partly balanced by the holding in the US pharmaceutical company Merck, which was the 9th biggest contributor. The group also highlighted strong performance with bumper dividends from the miners, including Rio Tinto, Anglo American, and BHP, increasing income from £3.9 million to £6.3 million. The City of London's net asset value total return was ahead of the FTSE All-Share Index over 1, 3, 5, and 10 years. Commenting on the portfolio outlook, Mr. Curtis and Mr. Smith, the chief fund managers, commented, consumer staple companies which make and sell everyday products constitute 20.5% of the portfolio. They tend to have a degree of pricing power to cope with inflationary cost pressures. 3 of the 10 largest stocks in the portfolio are consumer staple companies: British American Tobacco, the largest holding, and Imperial Brands, the 9th largest holding, have strong cash flow to support their dividends. British American Tobacco has also made significant progress in the transition towards less harmful products and is the leader in vaping, with views in the United States. Diageo, the 3rd largest holding, is the world's largest spirits company outside China, as well as owning Guinness. Leading spirits brands its own include Johnnie Walker, which is Scotch whisky, Tanqueray gin, Smirnoff vodka. It has also grown to become the market leader by value of total sales in tequila, which is the fastest growing spirits category in the US, with brands such as Don Julio and Casamigos. Tesco's, the 11th largest holding, and Unilever, the 12th largest holding, are consumer staples companies. Tesco's has market leadership and competitive pricing in the UK food retailing. Unilever has sales from its beauty and personal care, food and home care divisions in both developed and emerging markets. The oil sector is represented in the top 10 by Shell, their 2nd largest holding, and BP, the 10th largest holding. Both companies benefit from the elevated price of oil, which is likely to persist given the imbalance between demand and supply in the global market. Long term, a key determinant of their performance will be how well they execute on ambitious plans to achieve net zero, which means completely negating the amount of greenhouse gases they produce. They aim to achieve this by reducing fossil fuel exposure, investing in renewable energy, in brackets wind and solar, and developing carbon capture technology. National Grid, the 13th largest holding, and SSE, the 17th largest, are both well placed to benefit from electrification of the company and growth in the renewable energy sector. It is likely that governments will increase defence spending given the rising threat from hostile countries. The products made by BAE Systems, 4th largest holding, are of crucial importance in this context. RELX, 5th largest holding, which provides essential information and analytics for businesses, professionals, and scientists, is expected to continue in its outstanding record of steady growth. The pharmaceutical sector constitutes 8.9% of the portfolio. The 2 largest holdings are UK listed, AstraZeneca, the 6th largest holding, and GlaxoSmithKline, the 8th largest holding. In addition to 4 overseas pharmaceutical companies are held Merck, Novartis, Johnson & Johnson, and Sanofi. These companies have a strong record of bringing to the market medicines and vaccines that improve health, prolong and save lives. Given its importance and this large scale of funding from governments, healthcare spending is fairly resilient in a period of slowing economic growth. And finally, HSBC is the 7th largest holding, and there are also a smaller number of positions in Lloyds Banking and Barclays within the portfolio. Banks should benefit from the rise in interest rates as they were able to improve rates for deposit accounts and margin between deposits and loans. Banks are vulnerable to loan losses and impairments if the rise in interest rates leads to a recession. Life assurers Phoenix, 16th largest holding, and Legal & General, 19th largest holding, offer high dividend yields, as does M&G, the 15th largest holding, which is a mixture of fund manager and life assurer. In terms of the percentage derived from different geographical regions, 33% comes from the UK, 24% from North America, 15% from Europe excluding UK, 12% from emerging markets other, 10% from emerging markets Asia, 3% from developed markets in Asia Pacific, and 3% from Japan. Valuation we commented on earlier, it trades at 2.5% premium to its net asset value. Reading more about the City of London Investment Trust, the more I liked it. It is very defensive, and I certainly think where we are in the cycle at the moment, holding those sorts of defensive companies would give you it would help you sleep at night for sure. And I think you'd probably see a much smaller fluctuation with much more resilient earnings from this investment trust. I guess the big question is what you're investing for, what your time horizons are. Because if I were being critical, while there are a lot of very high quality defensive companies in there, is where does the long-term growth come from? And is it just from sort of, I suppose, small amounts of sort of revenue growth and reinvesting those dividends? Or are the sort of companies of the future in there? I suppose they are trying to point towards some, whether it's British American Tobacco and the electronic cigarettes, or whether it's the oil and gas producers and going into sort of renewable energies. But there's not a huge amount in there. And I think as a younger investor myself, that would probably concern me, whilst I think they do have a lot of, high quality, in particular the consumer staples companies in there. So it probably wouldn't be one for me, but I can see why in the current market with what's going on, it trades at a slight premium, and they do have an excellent track record. So not one for me, but I quite like the strategy. Sam, what are your thoughts?
It's interesting. I like the makeup of the portfolio, probably not quite as much as you did, but it is an interesting portfolio. It's not a fund. I mean, we hardly ever look at funds anyway on the show, but it's not a listed fund I've ever looked at in any detail. There's quite a few favorites of the show in the top 10. So I can't really knock it too much. I just think for me personally, although there's a lot of companies in the portfolio I like, I don't see what I'd need them for. I feel like I could do a pretty good job recreating a similar portfolio myself.
Do you think buying the FTSE 100 would be a similar portfolio?
I don't think it'd be too dissimilar, to be honest.
I
guess the thing with the FTSE 100 is, although there are a lot of good businesses in there, there's also a lot of businesses you wouldn't want.
Yeah.
But I don't think it would be that. I don't think it would be that difficult to go down like the FTSE 100 and pick out 20 that I like that I think might outperform, and I'd probably get similar results without having to pay their fees. That's not to criticize them. It's just I feel like what they're providing just isn't really something that I need. But I do like the portfolio, and it is interesting to hear their thoughts on a lot of the stocks that we have covered multiple times on the show.
Yeah, well, I quite agree with you on that. Do you think if you were an older investor and you were using this more as, income, this would appeal to you a bit more?
If I didn't enjoy doing it myself, I think so. I think there would also be maybe a role to play in that. I think this probably does outperform the FTSE 100. What's in it? I would back it to outperform the FTSE 100, because a lot of the stocks in the top 10, they're certainly what I would consider to be some of the higher quality stocks in the index.
Sure.
So I think, if you were just looking to build a portfolio that you could just leave and not worry about and just take your dividends from, I think it's worth considering instead of maybe a FTSE 100 index.
It's not that expensive either.
No, and it's outperformed it by quite a fair bit, it sounds like, as well. So what you pay in fees, you are making up for in outperformance. Because the only I think it's fair to measure it against, you'd measure it against the FTSE 100 or the all share like they measure.
Yeah.
And I think if you measure it against that, it's doing better. So yeah, I think it's definitely interesting, but not for me.
Yeah, no, I would tend to agree. Although what I think I enjoyed most was the analysis of the different sectors. And would you say it was similar to our take from the previous shows?
I think so.
Yeah,
I think a lot of the top 10. I think we've covered a lot of those. Well, we've probably covered all of them on the show, but I think we've spoken positively about most of them.
I think one thing I picked up on was one reason for slight underperform, or an area of underperformance, was selling or having a smaller Astra position, which made me think of the fantasy portfolio where we sold out of Astra.
Yeah, I wasn't going to mention that.
Which it can be part of our analysis when we come to the new year.
Yeah, we'll see. Oh, we don't know whether we've underperformed
We don't know what will
or
happen,
not.
but
We've not looked at it for 9 months.
Astra. Oh, I've taken a peek at it.
Have you?
Yeah, sadly for us, it's done quite well.
Oh, I don't want to know.
Okay.
Right. Okay. Should we move on to JD Sports
Yeah.
Fashion?
Yeah.
I think it's a brand that most people in the UK will be aware of. They sell trainers and the shops are quite cool. So they have come out with their half-year results to 30 July 2022, and revenue is up 13.7% to 4.418 billion, and the gross profit percentage is flat at 48.5%, and the operating profit is down 16.1% to 332.9 million. Earnings per share are down from 4.44p to 3.58p, and they've reinstated the dividend at 13p a share. So they've said in the highlights that results for the first half were at the top end of the board's expectations. They've highlighted continued robust performance in the sports fashion retail in the UK and Republic of Ireland, which delivered a profit before tax and exceptional items for the first half of 153 million, down from 174 million last year. Highlighted a return to profit in the sports fashion retail in Europe, which contributed to a profit before tax and exceptional items for the first half of 57.1 million, up from a loss of 7.2 million last year. And they've also highlighted a profit for the sports fashion retail in North America of 130.4 million, down from 245.5 million a year ago, with the performance in the period reflecting, as expected, the non-comparability of trading conditions in the US as a result of the federal fiscal stimulus in the prior year and the supply chain challenges of certain international brands, which has led to reduced availability of key footwear styles, particularly in the first quarter. Total revenue growth in organic retail businesses was 5%, with this level of growth continuing into the second half to date, including a return to growth in the United States. The international development continues to progress positively, with 51 net new JD stores opened across Europe, including a first store in Hungary and a first store in Greece due to open shortly. 101 stores now trading as JD in the United States, with the flagship in Chicago due to open in the second half. They've got 4 JD stores in Indonesia and 2 in Israel, opened under joint venture arrangements. So they now have a retail presence in 27 countries. And there's been further progress in Australia, with 3 new stores open in the period and a first store in Adelaide open subsequently. There are a few interesting points in the slides. Yeah, so the 5-year history of revenue by sector. UK and Republic of Ireland in the past 5 years, revenue is up from 1.038 billion to 1.81 billion. Europe's up from 536 million to 1.16 billion. Asia Pacific's up from 91.2 million to 197.9 million, and North America's up from 180 million to 1.292 billion. Although that's mainly through acquisitions instead of organic. For each division, the profit and loss to July 2022 was 154.8 million for UK and Republic of Ireland, 34.8 million for Europe, 29.2 million for Asia Pacific, and 111.1 million for North America. And the number of stores at the end of the period was 440 in the UK and Republic of Ireland, 428 in Europe, 82 in Asia Pacific, and 937 in North America. And I've pulled out the Shoe Palace results just because that's a recent acquisition. So that's only from the last couple of years. That's one of the American acquisitions they've made. But revenue was down 10.9% to 253.8 million, and the gross profit percentage was up from 49.4% to 51.9%. Business trades at a PE ratio of 16, and that's after a 53.29% drop in the share price for the past year. I think it's a good brand. I'm not a huge fan of retail just instinctively. But in the UK, I think JD is an extremely strong brand. And I think for now, at least, the bigger companies like Nike and Adidas, they do need JD in the UK just because they are that big. So you get a lot of it. Look, you get quite a few like exclusive releases and stuff with JD. What I don't like is the acquisition strategy. I think JD is a very, very good brand, and it would be interesting to see how it does internationally. I know there's a lot of international already in the business, but it'll be interesting to watch international. But just because it's a really solid brand here, it doesn't necessarily translate to a really good brand in, say, like Malaysia or Australia. I think that brand has taken a long, long time to cultivate. I mean, like when I imagine it was the same for you, John. When we were at school, like if someone came in with like a yellow JD bag, that was quite cool. It takes a long time to build that. You can't just go and like launch. It is really difficult. So I don't know if the brand will necessarily translate as well internationally because there's not really anything special about it. But I don't like the US strategy. So I'll just read from an article about the Shoe Palace acquisition. So this is a couple of years old, this article, but JD Sports bought California-based Shoe Palace for $681 million. This is the second US acquisition. The company entered the market in 2018 with its $560 million purchase of apparel company, The Finish Line. Other recent acquisitions include Livestock, a Canadian company bought in July, and UK menswear company Pretty Green. Also looking to buy UK rival Foot Asylum. I don't think that ever went through, did it? Also, they also tried to buy Debenhams, but for Shoe Palace, they paid $325 million in cash and issued a 20% stake in the new US subsidiary, which was worth a further $356 million. I just think I don't know these brands, and it might be that Shoe Palace and the Finish Line are really, really good brands, but my instinct is they're not fantastic brands, and I think they're possibly buying stores. And in doing so with some of these brands, I feel like they might be diluting the average quality of the store. I'd be surprised if the Shoe Palace is as cool in the US as JD is here. And that would be my concern, is that although they are growing profits and they're growing them very well, you just, at some point, you end up with some just very average brands in there. And when you've got Nike and Adidas all going for more direct to consumer, retail's quite tough anyway. I think the situation very quickly reverses. So for me, it's interesting to watch, but I wouldn't really be comfortable holding this in the long term, partly because it's retail and partly just that acquisition strategy, as strong as I think the brand is in the UK. John, what are your thoughts on the results and the valuation?
I mean, I think the valuation is certainly, it's not expensive, and by historical standards, I think it's about the cheapest it's been in nearly 10 years. And if you look at the forward earnings, it's under 10 times the forward earnings. One thing, aside from the acquisition strategy, that worries me is the direct consumer, and you're seeing the big brands like Nike and Adidas going down that road, and I don't see why it would stop. I recently bought some trainers, and a few t-shirts and things straight onto the Adidas website. They offer you discounts. It's straight to you. You don't need to go to JD. I know that they cultivated that brand in the UK, but I would wonder whether that is, you've seen the peak growth there. And yeah, how translatable is that overseas? I'm not completely convinced by it. It is cheap. It's retail, which I've recently been burnt by, and well, that those results are out tomorrow. But I don't think it's one for me. I think it'll be interesting to see where it goes, and it's certainly not expensive. But for those reasons, I wouldn't invest.
Right. Well, I don't think there's much more to say about it.
Yeah.
But yeah, they are good results. That's the funny thing about it. It's just the overall strategy I don't like. Right. Should we move on to another debut?
Another debut, yes. So we've talked about it a few times before. First of all, when Unilever made a bid for Haleon, which is the consumer health company that was spun out from Glaxo. They've had their half-year results out for 2022. The portfolio includes brands like Sensodyne toothpaste, Panadol, Voltarol, Centrum, and Advil. In terms of revenue for the half, it came in at £5.2 billion, which represented organic revenue growth of 11.6%, with volume mix up 7.9% and price contributing 3.7%. Power brands grew revenue by 13.4%, and 2/3 of the business gained or held market share. In oral health, revenue came in at £1.4 billion, up 5%, with 3/4 of the business gaining or maintaining market share, including key markets such as the US and China, with strong performances from Sensodyne, Parodontax, Polident, and new formulations in all of those were released. In the vitamins, minerals and supplements division, there was double-digit revenue growth of 12% to £816 million, with market share gains in the US and China. In over-the-counter pain relief and digestive health, Panadol was the standout performer, helping revenue grow 12% to £1.2 billion. In respiratory health, demand was strong with the return of the cold and flu season after the lockdowns and COVID, with Theraflu helping revenue grow 47% to £683 million. In digestive health and other, revenue grew a more modest 3% to just over £1 billion. In terms of geographies, revenue from North America totaled £1.8 billion, which represented a 10.4% organic sales growth. Europe, the Middle East, Africa and Latin America generated just over £2 billion in revenue, representing organic sales growth of 12.1%. And Asia Pacific saw organic sales growth of 12.3%, with revenue coming in at £1.2 billion. Adjusted operating margins were 24.2% in North America, 22.6% in Europe, the Middle East, Africa and Latin America, and 24.1% in Asia Pacific. This resulted in an adjusted operating profit of £1.19 billion, up 15%, and an adjusted operating margin of 23%. R&D spend was 23% higher at £137 million, and sales, general and admin 9.3% higher at £1.9 billion. In terms of the costs of goods sold, commodity and commodity-related costs were less than 10% of sales, and full-year inflation is in the mid-teens for commodities and materials and slightly higher for freight. Energy costs account for only around 1% of cost of goods sold. They have 90% fixed contracts or hedged for the second half. The group planned to continue to offset rising costs with price rises and efficiencies. Net capital expenditure came in at £88 million and is expected to be around 3% of sales for the full year 2022. Free cash flow came in at £553 million, compared with £189 million in the first half of 2021. Debt as of the demerger stood at £10.7 billion, with a weighted average cost of 2.8% over 8.4 years. In terms of outlook, Haleon are expecting annual revenue growth of between 6 and 8% and adjusted operating margins to fall slightly at constant currency. Net debt to EBITDA is expected to fall below 3 times by the end of 2024, and an initial dividend is expected to be at the lower end of the 30 to 50% range of profits. The group stated that they are not party to any Zantac claims, and they have notified GSK and Pfizer that they reject their requests for indemnification. A joint venture agreement was signed, and in their view, the indemnity set out in the joint venture agreement only cover GSK and Pfizer consumer health businesses as conducted then, and at the time, neither GSK nor Pfizer marketed over-the-counter Zantac in the US and Canada. And that's one of the sort of grey clouds over the company at the moment. It was a drug for, I suppose, reflux and sort of excess acid in the stomach, and there have been links to cancer. It's a big issue in the States, and it's not clear, well, as clear as Haleon are saying it to be, over whether there's going to be further litigation over it. So that's the comment that they made on the issue in the slides. In terms of valuation, Haleon trades at around 17 times earnings and has a market cap of around £25 billion. I was actually pleasantly surprised by these results. I thought that they might be a very low single digits, and actually they were pretty good in comparison with certainly what I was expecting, and I think with what the market was expecting. The shares were up on the results, and it looks like an interesting company to me with a portfolio of very strong brands. People are always health aware. These are products that, I suppose, it's more the branding than lots and lots of intensive R&D spend like the true pharmaceutical companies. I suppose you'd argue that they don't hold the patents and they don't have the ginormous margins that the pharmaceutical companies would have in the long term, but the consistency of earnings is attractive. And certainly if they can grow them in the sort of higher single digits, it doesn't 17 times earnings, I suppose it's probably a fair valuation. I guess one of the things that might be holding it back further is that debt and also this issue over Zantac. I wouldn't like to comment too much on Zantac. I think that would be something that would require, if I were thinking about shares, definitely warrant further investigation. And yeah, the debt at the moment is on the higher side. But I think overall, looking at the company, I did quite like it. Would I add it to the portfolio? Probably not at this stage with those uncertainties. But in the longer term, I definitely keep it on my watch list and potentially add to it or start a position in it at some point, but too early at the moment. Sam, your thoughts on Haleon?
Like you, I was pleasantly surprised by the growth rates. I think they are impressive. However, I don't like the brands particularly. There's some decent brands in there, but it's not as good as Unilever's, for example. Not as good as Reckitt's. Not as good as Kraft's either, which is one we've covered a couple of times. So yeah, I'm not too keen on the brands. And I'm not too keen on the debt either. It's got quite a lot of debt. And I know they've said they want to, what did they say? They said they want to bring it down to 3 times underlying cash profits by the end of 2024. That wouldn't be such a terrible level. But that firstly assumes they don't have any extra debt from like the litigation or anything like that.
Yeah.
But also, I just think it's not the kind of company I'd really consider anyway. But if I were, I'd probably just say to you, well, I'll come back and have a look at it at the end of 2024.
Yeah.
And if it's in a bit healthier shape, like I don't think you're going to pay that much different in earnings, really. No.
And I think one thing that we'd mentioned before, obviously before we had these results, was how much Unilever were going to pay for it. And that was about double what it is now.
They should have sold it.
Yeah, they should have.
Is that the same Unilever CEO that's just announced he's leaving?
Yeah, it is very much the same.
Well, that's good news because that's just shocking.
Yeah,
because he was willing. So these are currently trading at forward PE of 13.7. So he was basically willing to pay a forward PE of like 27.
Yeah, for this company
for consumer goods, which is just crazy.
Yeah,
it just just screams of desperation, really, just panic. And he's like deadline day when you just sign anyone.
Yeah, well, he's going now, and I don't think will be well remembered by long-standing Unilever shareholders.
No, but yeah, decent results, and even with the debt and stuff, that's not really the company's fault. They've inherited it.
Yeah.
All you can really judge, like for example, the management on is the results themselves, and they are good.
Yeah. So it's the debt and the litigation
and the brands.
Well, okay, I quite like the brand. I mean, it would, at a good price, it would make a lot of sense for Reckitt, but they've done some big acquisitions that haven't gone well in their time, so I think they'll be staying well clear. But
I don't think they'd want that litigation either. They need a way of getting it where that didn't touch them.
Absolutely. I think it's an interesting one to watch, and I would come back to it again in the future more seriously.
Right. Okay. Shall we move on to Keyword Studios then?
Yes.
So
we first time on the show, or no?
No, we've covered it. I think we've covered it at least once before, possibly. Oh, no. I think as soon as us. So I think once I start talking about it, you will remember which company it is. Because it's got the names.
The memories are coming back. Actually,
here we go. So I'll just, for anyone else who's forgotten, Keyword Studios. So I'll just read from their website. So in their services, Keyword Studios continues to build world-leading capabilities in services that video game and similar interactive content creators need. Today, we have breadth and depth in 8 service lines: art services, game development, audio services, functionality QA, localization QA, marketing services, and player support. So basically anything you can really think of to do with video games, you can outsource it to these guys. They have come out with their first half results, and they saw double-digit growth across all service lines to its customer base of video game developers in the 6 months to June 2022. This drove a 34.5% increase in revenues to €321.1 million, and all the figures are in euros, of which organic growth contributed 21.7%. Underlying profit before tax was up 38% to €54.8 million, reflecting a margin improvement from 16.6% to 17.1%. But they have said that should move back down to historical levels of about 15%, which reflects increased investment in the business. We break the results down a bit more. Globalize, the largest division, which includes the audio testing and localization. For that division, revenue grew 31.8% to 141.5 million, with organic growth, excluding acquisitions, growing 25.7%. The division benefited from an upswing in the game's development cycle, and underlying cash profit was up 47.4% to 31.1 million. The Create division, which combines art services and game development, saw sales growth of 44.5% to 124.3 million, reflecting a material contribution from acquisitions, but also organic growth of 23.3%. A strong client demand continued. A further addition to this division was the announcement of the proposed acquisition of Canadian development studio Smoking Gun for up to 40 million Canadian dollars, funded through cash and shares. Smoking Gun is expected to grow strongly over the next 12 months and is expected to deliver cash profit of around $6 million against an underlying cash profit of 30.9 million for Create as a whole in the first half, which was up 34.3%. Engage covers marketing and player experience services, and that saw a revenue growth of 22.1% to 55.3 million, with more modest organic growth of 9.8%. This was against an exceptional period of growth for marketing services in the comparative period in 2021. Underlying cash profit margins in this division were unchanged at 14.6%. Cash conversion did not quite keep pace with profits, with free cash flow broadly flat at 24.3 million, including a negative working capital movement of 12.7 million. Net cash was up to 121.3 million versus 84.1 million at the end of June 21. In terms of valuation, the business trades at a forward PE of 25.5, and that compares to a 10-year average of 28.9, and the prospective yield for the next 12 months is 0.1. So these results are obviously fantastic. If we go and look at the 5-year results, they're also fantastic. So between 2017 and 2021 full years inclusive, revenue increased from 151 million to 512 million. Operating profit was up from 16 million to 50 million. Diluted earnings per share was up from 11.87 cents to 42.98 cents. So this is just fantastic set of results. Clearly a fantastic business. I think these are really, really impressive considering how well the industry it's in did in a comparative period. It is up against very tough comparatives, and it's absolutely smashed them. However, I do like this business a lot. I think it looks very well run. I think someone who feels like they understand the gaming market quite well and knows probably more about the industry than I do, maybe might want to take a serious look at it. But my concern is, I know the gaming market's huge and probably going to get a lot bigger. I don't know how big the outsourcing market is. And that's not a criticism of keywords. I just don't know. It's not really my area. So you are buying it for growth. It's not, I think, given how good the results are and the historical results, I don't think it's outrageous at 25 times earnings. I think that's fairly reasonable if you think it can carry on doing what it's doing. My concern is I just don't know how big it can get. And because I don't really know the market very well, I can't really picture it and say, well, it's currently making 50 million operating profit per year. I think it could be doing 500, in like 10 years time. I can't visualize that. And that's my issue with it. So for me, I think it's a fantastic business. There's nothing about the business that wouldn't make it good enough for the watch list. It's more, for me, it just goes in the too hard pile. So I would regrettably just say no to it, but it does look like a fantastic business. John, what are your thoughts on the results and the business?
I mean, I thought the results were clearly they were really impressive results. The business, again, lack of knowledge about the industry, and it's expensive, although I appreciate the growth that it's delivering. would partly justify that high price. But I think not having any knowledge and it being quite a technical area, I'd probably be staying away. But it's not, like you say, it's if you dug into it a lot more and you understood the industry, it could well be a fantastic business that actually, even at that price, is a good buy.
Yeah, it's not a criticism of the valuation. It could be a bargain.
Yeah.
We just don't know.
Yeah.
But yeah, it's AIM listed as well. I should have mentioned that.
Yeah.
Right then, shall we move on to PZ Cussons, a business that's a bit easier to understand?
Yeah, it is much easier. It makes, we've covered it on the show before, but it's consumer goods company, makes Imperial Leather, Original Source, and Carex, the hand gels, amongst others. They had their full year results out for 2022, with revenue declining 1.7% to £592.8 million, with like-for-like growth of 2.9%, more than offset by disposal and FX. Operating profit was also down from £71 million to £67.9 million. And the group cited normalisation of Carex volumes as the main drag and declines in Europe and America. Despite this, market share was higher than pre-pandemic. Volumes overall were down 3%, but there was a price mix growth of 5.9% and growth of 7 out of 8 must-win brands, including Saint-Tropez and Original Source. In geographies, Europe and the Americas generated revenue of £193 million, down 12.3%, and Asia Pacific saw growth of 3%, whilst Africa grew revenue an impressive 22.3% to £222 million. Operating profit margin was 18.1%, 12% and 10% respectively. Operating profit margin was squeezed to 11.5% from 11.8%, with 11% or £40 million worth of cost inflation being limited by cost mitigation and management initiatives. Profit before tax was £66.6 million, falling from £68.6 million in 21. Free cash flow came in at £58 million, down from £64.4 million. Net debt to EBITDA had a ratio of 0.1 and net debt totaled £9.8 million. The group disposed of 5am for £6.4 million in June 21 and Nigerian property for £18.4 million and acquired Child's Farm in March 2022 for £37 million. Going forward, the group reports a strong start to full year 23, with group like-for-like revenue up 6.7% overall and expected to deliver full year 23 in line with expectations. In terms of valuation, PZ Cussons has a market cap of £829 million and trades at 16 times earnings, yields just over 3%. I thought these results were disappointing, with pre-tax profit falling 2.9%, with cost inflation beginning to bite. But it is, and it has been for a long time, a turnaround project. And that was before the pandemic and the boost that gave, particularly to Carex, which is the hand gels. But the brands are still strong. Carex is the UK's number one hand wash with 37% of the market share. Saint-Tropez is the US's number one fake tan brand with 20% market share. And Morning Fresh washing up liquid has a 47% market share of detergents in Australia. So there is hope there, and that turnaround is still ongoing. But I think, as you alluded to, Sam, when we covered Haleon earlier, there are better consumer goods companies out there than PZ Cussons. So it's a bit cheaper, but I think it's not that much cheaper. And I would certainly be choosing other consumer goods companies before PZ Cussons. What are your thoughts on these results and PZ Cussons as a company?
I thought they were very disappointing. I thought a revenue drop is just, unacceptable, probably is the word I would use. Like, even Unilever grew revenue. It's just, like Unilever's revenue growth was 7% or something like that, maybe even a bit higher. I can't remember because we covered it a couple of months ago, but every other consumer goods company we have looked at in the last couple of months has grown revenue, and they haven't. I think there are some good brands. There are some brands in there that I like. I think some of the bigger brands they've got, I appreciate they will be up against tough comparatives. I think they will have had more lockdown winners because some of the stronger brands, it's like the Imperial Leather Soap and the what's it called? You know, the tingly shower gel.
Yeah, that's Original Source.
Original Source, yeah, that's the one. Yeah, I think that will have had tough comparatives as well. But even still, even if it was low single digits, I just think they should have grown really.
And it's 16 times earnings.
Yeah, that was my next point. I just think it's, this is a turnaround, and it's not really trading at much of a discount to something like a Union. I mean, Unilever's a turnaround as well, actually. But it's not that far off Reckitt, which is in pretty healthy shape. So I don't know why you'd take the chance on it when it doesn't. There's not really that much of a difference in price.
For reference, Unilever is currently trading at about 20 times earnings.
Is it?
Yeah, but Reckitt is cheaper at 14 times earnings.
What? Why is Unilever? What's happened to the Unilever share price?
The chief executive's left.
What's it at now?
It's about £40.
Oh, is it? Reckitt 40. Well, that's like so. Like, why would you
I've got the wrong numbers, Sam?
I mean, it could just be that we're looking at comparatives, and they've I don't know. I don't know, but anyway, like the point is, like, it's not going to change. These companies don't change that much year to year. So, like, even if the Reckitt's different, it's not going to be that different. So, why, if you can get Reckitt for a similar price, I don't know why you'd get PZ Cussons, which is a turnaround. It just doesn't. I guess it's a lot smaller, so maybe you think there's a lot more growth potential, but I don't know. If I was interested in buying a stock in the consumer goods industry, I wouldn't be picking PZ Cussons at the minute. I just don't think you need to take the chance on it when there's so many other quality options available.
Okay. Final company of the week, and the US listed one, Costco.
Yes, Costco. So I'm sure it's a business that needs no introduction. So they have come out with their Q4 and 52-week results for the 16-week Q4 and the 52-week fiscal year, which ended on 28 August 2022. So net sales for the quarter increased 15.2% to $70.76 billion, and all these figures are in dollars, up from $61.44 billion last year. And net sales for the fiscal year increased 16% to $222.73 billion, up from $192 billion last year. Comparable sales per geography were as follows. US was up 16.8% for the quarter and 10.4% for the year. Canada was up 13.4% for the quarter and 12.1% for the year, and other international was up 2.9% for the quarter and 10.2% for the year. And e-commerce was up 7.1% for the quarter and 10.4% for the year. Net income for Q4 was $1.868 billion, which was $4.20 per diluted share, compared with $1.67 billion or $3.76 last year. Last year's fourth quarter was negatively impacted by a write-off of information technology assets of $14 per diluted share. Net income for the fiscal year was $5.84 billion or $13.14 per diluted share, compared to $5.01 billion or $11.27 per diluted share in the prior year. Costco currently operates 838 warehouses, including 578 in the US and Puerto Rico, 107 in Canada, 40 in Mexico, 31 in Japan, 29 in the UK, 17 in Korea, 14 in Taiwan, 13 in Australia, 4 in Spain, 2 in France, 2 in China, and 1 in Iceland. Costco also operates e-commerce sites in the US, Canada, UK, Mexico, Korea, Taiwan, Japan, and Australia. These are pretty solid results, as you would expect from a business with Costco's reputation. So you might be thinking, well, this sounds like a business that you might be interested in taking a look at. And then you get to the price. It trades at a PE ratio of 37.7.
Oh.
Yeah. And a market cap of $212 billion. I mean, it's a fantastic company. Absolutely. Really impressive company. I mean, some of the top investors in the world will bang on about Costco. Charlie Munger's a prime example. There's a lot to like about the business, but 37 times earnings for a business with a 200 billion market cap that's growing at 10% a year. That's the end of the analysis for me. I didn't go any further. I just don't. It also has a dividend yield of 0.77%, but really good business, good results. I just don't know who's paying 37 times earnings for this business. John, what are your thoughts on the results and the valuation?
Yeah, I mean, great business, great results, but goodness, you struggle to get past that valuation. I was going to ask Sam, do you have the data in terms of its historical valuation? Has it always been this expensive, or is it trading at a particular premium at the moment?
I know it's been expensive for a while. I've only got the share price. It's down. This is after it's come down, like,
oh goodness,
probably like getting on for 20%. This is after about a 20% drop. I don't know. I suspect it's always been expensive, but 37 times earnings just seems crazy. It's possibly one of. I'd say this is
before I'd buy.
Yeah,
I'd buy before.
I actually would say this is possibly one of the most expensive stocks we've ever looked at, just because, a lot of the businesses we've looked at before, where they're trading at multiples of sales or whatever, they've still got a lot of growth ahead of them. Whereas with Costco, it's a really well-run business, but I think it's fairly saturated. I mean, it's already at a $200 billion market cap. It's just, I don't know who's buying it at 37 times earnings and expecting to make a market-beating return from it. It just baffles me. But anyway,
I tend to agree with you on that. So of the companies, what would you be going for with your own money?
I'd go with City of London Investment Trust.
Quite boring as well, but I think I would also go with City of London Investment Trust, and I do hold a few other companies that they also hold.
Yeah, so it's just, for me, it's lack of other options. I think in this week's lineup, in all the other five, there is a reason why I wouldn't invest, and fairly strong. The only one I would consider is Keywords Studios, but I just don't understand the market. So by default, I end up in City of London Investment Trust, just because I know what's in it, I understand what's in it, and I do like what's in it. But yeah,
I think I'd sleep well with City of London too, in terms of the volatility.
I wouldn't sleep well with Costco.
No, absolutely. But no, I think that probably sums it up this week.
Yeah.
And next week, one of our favorite companies, Boohoo, has got a trading statement out. So we'll be sure to cover that. So join us then.
See you next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.